Hey everyone, welcome back to Corporate Decoder, the place where let's just say this company is going through some serious changes, and you are going to want to hear how it is playing out financially. Get ready for a deep dive into Galera Therapeutics' latest quarterly report, where we'll uncover the real story behind their revenue, expenses, and what it means for their future. Before we start, if you appreciate getting straight insights from corporate documents, make sure you are subscribed. We also have a Discord community linked in the description below where we discuss these findings and much more. Alright, let's get into it. Galera Therapeutics Inc. is here with their Form 10Q, which is basically their quarterly checkup on how they're doing financially. This is for the period ending the 30th of September 2025. First up, let's look at their balance sheet. This is like a snapshot of what the company owns and owes at a specific point in time. As of the 30th of September 2025, their total assets were around $5 million. That is a pretty big drop from the 31st of December 2024 when they had over $10 million in assets. Where did all that cash go? Their cash and cash equivalents went from over $8 million at the end of 2024 down to about $4.5 million by September 2025. That is a significant decrease, and it tells us they've been spending money. On the flip side, their total liabilities were about $151.6 million in September 2025, down a bit from $153.7 million at the end of 2024. A big chunk of that is this royalty purchase liability, which is a massive $151 million. This is essentially a debt tied to future royalties from their past product candidates. They also have this Series B redeemable convertible preferred stock. It is a bit of a mouthful, but it is essentially a special type of stock that has certain rights. The amount they have outstanding went from about $4.4 million to $2.6 million. Now, let's talk about the elephant in the room, their accumulated deficit. This is the total of all the losses the company has had since it started. As of the 30th of September 2025, it reached a whopping $460.4 million. That is a lot of red ink, folks. It was already a huge $456.4 million at the end of 2024. This really shows they've been burning through cash for a long time. Moving on to the income statement, this shows us how much money they made or lost over a period. For the 3 months ending the 30th of September 2025, their net loss was about $1.4 million. Compare that to the same period in 2024 where they lost over $5.5 million. So their losses are shrinking, which is a good sign. Looking at the longer 9-month period, their net loss was about $4.1 million in 2025, a big improvement from over $14 million in losses for the same period in 2024. This shows a definite trend of reducing losses. Their spending on research and development has also drastically decreased. In the 9 months of 2024, they spent over $3.2 million on R&D, but in the same period of 2025, it dropped to just $307,000. This is a massive cutback, and it tells us they are no longer heavily investing in their old drug pipeline. General and administrative expenses also saw a significant drop. For the 9 months ending the 30th of September 2025, these costs were about $4.2 million, down from over $9.3 million in 2024. This suggests they've streamlined their operations and cut down on overhead. One very interesting line item here is the write-off of acquired intangible asset and write-off of goodwill. In the 9 months of 2024, they recorded almost $2.3 million for intangible assets and another $881,000 for goodwill. This usually happens when a company realizes that an asset they acquired is not worth what they thought it was, or they stop developing a product associated with it. Given the context of their divestitures, this makes sense. And get this, in 2024, they recorded a gain of nearly $1 million from a litigation settlement. That is a nice one-time boost. Now, let's look at the statement of changes in stockholders' deficit. This statement detailed how equity changed over time. It shows a significant increase in the accumulated deficit, reflecting the ongoing losses. By the 30th of September 2025, their total stockholders' deficit was negative $149.2 million. That is a sizable hole. The cash flow statement is crucial. It tells us where the company's cash came from and where it went. For the 9 months ending the 30th of September 2025, they used $4.5 million in operating activities. This is expected given their continued unprofitability. This use of cash is primarily to fund their ongoing operations, which is normal for a company in their stage. Interestingly, they had $635,000 in net cash provided by financing activities in the 9 months ending the 30th of September 2025. This came from a private placement of stock. Now for the really important part, the notes to the financial statements. This is where companies explain the details behind the numbers. The company has undergone a major transformation. historically focused on small molecule dismutase mimetics for cancer radiotherapy. They sold off these assets, including avacipasim and ricosapasm, to Biosol Incorporated in October 2025. Big change, number one. Then, on the 30th of December 2024, they acquired Nova Pharmaceuticals Incorporated. Nova is developing a drug that targets nitric oxide synthase to treat resistant breast cancers. This acquisition signals a major strategic shift for Galera Therapeutics. They're no longer in the radiotherapy business. Let's talk about liquidity, or how much cash they have to operate. As of the 30th of September 2025, they had $4.5 million in cash. They believe this, plus about $3.5 million from the sale of their old assets, will last them at least 12 months. But they are very clear. They do not have enough cash to adequately fund the development of their new products and will need to raise more money. They did a private placement in December 2024, bringing in about $2.9 million. This was at a very low price per share, just 6.5 cents. That is a sign they were desperate for cash, and investors were taking a big risk. This section tells us how they prepared these financials. It is all in accordance with generally accepted accounting principles, or GAAP, which is standard. They're pretty much operating as one single business segment now, under their CEO. This means all their financial information is viewed as a whole. They define cash equivalents as highly liquid investments that mature within 3 months. Their cash is mostly in bank deposits and money market funds. The pre-funded warrants issued in that December 2024 private placement were initially treated as a liability because of redemption features. However, they were later amended and reclassified as equity. This shows a complex financial maneuver. This part details their Series B redeemable convertible preferred stock. It is classified outside of stockholders' equity because it can be redeemed by holders under certain conditions, essentially putting it in a position similar to debt. They expense R&D costs as they are incurred. For third-party services, they estimate costs based on the work completed. This is pretty standard for biotech. The filing mentions a tax law change in July 2025, but says it won't materially impact them due to a full valuation allowance on their deferred tax assets. However, they did write off a significant amount of net operating loss carryforwards and tax credits in the quarter ending the 30th of September 2025. Because of a Section 382 study that identified an ownership change on the 30th of December 2024. This means a portion of those valuable tax benefits will likely expire before they can be used. Here they explain how they calculate earnings or losses per S-share, basic loss. Per S-share is calculated by dividing net loss by the weighted average shares. Diluted loss per S-share considers potential shares from options and warrants. But when a company has a net loss, these dilutive securities are excluded because they would actually reduce the loss per S-share, making them anti-dilutive. As of the 30th of September 2025, they had over 10.9 million stock options and over 13.8 million common stock warrants that were excluded from diluted share calculations because they would be anti-dilutive. This section details the acquisition of Nova Pharmaceuticals. The upfront payment was about $2.6 million in Series B preferred stock. It also reiterates the details of the private placement. This explains how they value certain assets and liabilities, classifying them into level 1, 2, or 3 based on how observable the market prices are. Their money market funds are level 1, meaning they are valued based on quoted prices. Their money market funds, which are part of their cash equivalents, are valued using level 1 inputs, meaning quoted prices in active markets. The warrant liability they talked about earlier was essentially zeroed out by the 30th of September 2025 as it was reclassified to equity. This just breaks down their prepaid expenses like insurance. It shows a decrease in prepaid insurance from over $795,000 at the end of 2024 to $152,000 by September 2025. They wrote off their remaining fixed assets in the third quarter of 2024 when they terminated their office lease. They had no depreciation expense in 2025 for property and equipment, which makes sense if they sold off or got rid of most of their assets. This is a breakdown of their accrued expenses, which are costs incurred but not yet paid, like compensation and professional fees. Here is that massive royalty purchase liability, again, stemming from an agreement with Blackstone Life Sciences. They received quite a bit of money up front in tranches, but it is accounted for as debt, although they suspended interest expense recognition on this in late 2023. They've now assigned all rights and obligations related to this to Biosol in October 2025 as part of that asset sale. They terminated their office lease in August 2024 and paid a termination fee. Then, in January 2025, they signed a new, shorter 12-month lease. The lease expenses reflect this transition. This section covers their license agreements. Their subsidiary Nova has an exclusive license from Houston Methodist for oncology patents. There are due diligence requirements like submitting an investigational new drug application by 2028, and royalty payments and fees are tied to future commercial success. This details their equity incentive plans, which is how they compensate employees and executives with stock options and awards. They have an older plan and a newer 2019 incentive award plan. The total shares available for future issuance under the 2019 plan was over 2.4 million as of September 2025. This is where we see transactions with people who have close ties to the company IntellectMap, whose CEO is related to Galera's CEO, provided it advisory services. Also, 2 board members, Dr. Chang and Mr. Friedman, received significant amounts of Series B preferred stock in the Nova acquisition, demonstrating their prior involvement. Mr. Friedman also provided corporate services as an independent contractor. This is critical. In October 2025, after the period covered by this report, they sold all their assets related to avacincaptad and ricocaptad, and any other dismutase mimetic assets to Biosil. They got an upfront payment of $3.5 million and could get up to $105 million more based on future milestones. This sale, combined with the Nova acquisition, fundamentally reshapes Galera's business. This is where management explains the story behind the numbers. They reiterate the sale of their old dismutase assets and the acquisition of Nova. They clearly state that their strategic focus is now on developing the PAN, NOS inhibitor for breast cancer. They acknowledge their history of recurring losses and negative cash flows. They've primarily funded operations through equity sales and that big royalty agreement. The sale to Biosil and the Nova acquisition are the major strategic moves discussed here. They are very upfront about the uncertainty of future revenue. They admit they may never succeed with their product candidates and expect to keep losing money for the foreseeable future. Their net loss for 2024 was nearly $19 million, and they ended September 2025 with only $4.5 million in cash and that massive accumulated deficit. They break down their expenses. Research and development costs are expensed as incurred. This table shows the sharp decline in R&D spending. For their old drug avacincaptad, R&D costs went from negative $159,000 in the 9 months of 2024, which might indicate a credit or reversal to $59,000 in 2025. Ricocaptad costs also dropped significantly. The other research and development expense is also down, and importantly, personnel related and share-based compensation expense for R&D dropped from over $2.1 million in 2024 to just $19,000 in 2025. This strongly suggests they've largely exited their previous R&D efforts. Their general and administrative expenses are also down, which aligns with the overall cost-cutting and strategic shift. They discuss their net operating loss carryforwards, which are valuable tax assets. However, the Section 382 ownership change study is a major point. They wrote off a large portion of these NOLs because they will likely expire unused after the acquisition. This is a tough reality of the business. This table directly compares their financial performance. Research and development expenses are down by $2.9 million for the 9-month period. General and administrative expenses are down by a massive $5 million. The write-offs and litigation settlement gains are clearly non-recurring, which explains why those numbers don't appear the same in 2025. They explicitly state they have ceased all clinical trial activity and suspended the development of certain product candidates. This confirms the massive shift away from their old strategy. They reiterate their liquidity situation. With $4.5 million at the end of September 2025 and the $3.5 million from the Biosil sale, they have enough to operate for about a year. But beyond that, they need substantial additional financing. They mention equity or debt financing or strategic transactions, and warn about significant dilution to stockholders if they issue more equity. The cash flow from operations shows a significantly lower cash burn for the 9 months of 2025 compared to 2024, which is a positive sign of their cost-cutting efforts. This is the laundry list of all the documents filed with the report. Now, let's look at the bigger picture. Galera Therapeutics is in the midst of a radical transformation. They've shed their old pipeline, selling off their dismutase mimetics assets. This was a necessary move, as those programs were likely not progressing as hoped and were a drain on resources. The acquisition of Nova Pharmaceuticals Incorporated marks a new chapter with a focus on breast cancer treatments. This is a high-stakes gamble. The market for targeted cancer therapies is competitive, but if their new drug candidate shows promise, it could be a game changer. Financially, the company is still in a precarious position. Their accumulated deficit is huge, and their cash runway is limited to about a year, even with the recent asset sale. They are clearly signaling their need for more capital. The low price of the private placement in December 2024 suggests investors were taking on a lot of risk. The reduced spending on R&D and general administration is a clear sign of streamlining, which is good for survival. However, it also means their old growth engine has been shut down. The success of this new direction hinges entirely on the Nova acquisition and the potential of its drug candidate winning regulatory approval and achieving commercial success. The biggest risk is their need for continued funding. If they cannot raise more money, or if their new drug candidate fails in trials, they could face serious challenges, potentially even dissolution. The write-off of goodwill and intangible assets also suggests that past strategic decisions may have been costly. Overall, Galera is a company in transition, betting its future on a new direction. Their financial health remains fragile, and their ability to execute on this new strategy will be critical. The next few years will be make or break for Galera Therapeutics Incorporated. Alright, that is our breakdown of Galera Therapeutics' latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.